Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing stocks with X dividends next week. So every week on Wednesday, I go over stocks that have X dividends next week. We use Dividend.com to pull the information and screen for stocks basically that are coming up with X dividends next week. We then screen them for price earnings ratio less than 25. I use the average of the S&P 500 and then round it up. Currently, it is at 24.19, currently where the S&P 500 sits. So I just round that up to 25. And then dividend yield, I then use a 1.5% dividend yield in order to screen the other stocks here. And then we round down for this number. Now, after we have screened the stocks for dividend yields over 1.5, PE ratios under 25, I then look for stocks that have rising revenue, rising net income, and rising free cash flow over the last 10 years. Depending on how many stocks we have remaining, I like to see a good number of about 3 to 6 stocks. I then leave it up to you guys. We'll then go over to Dividend.com, see how long they've been paying out dividends, go over when their ex-dividend date is, when you would get paid if you were to buy that stock prior to the ex-dividend date, and then I leave it up to you guys at that point, depending on what stock you would like to look at a little bit further. Go check out their balance sheet, their last couple yearly reports, their last earnings reports. Go take a look at what products and services they offer. What's their moat? Is it a very competitive moat, or do they have a very good advantage, such as Boeing in the airline industry, or Caterpillar in the industrial and tractor and all sorts of other stuff there. So depending on the moat, I already see here Caterpillar and Colgate on the list here. So we're going to be screening some stocks. So I'm going to go ahead and start first at Dividend.com. Of course, I'm doing this live. Last week it looked pretty good. I like to see if there's anyone chatting and anybody would like to ask questions. I understand it's a little bit late. It's 11:30 here on the Pacific, on the West Coast, but I still wanted to do it a little bit live, and I can adjust that here later. I would have liked to have done it sooner. Anyways, if you're brand new to the channel, hit the subscribe button. If you do like the video, give it a thumbs up. So let's go ahead and start here. I'm going to start at Dividend.com. I've already selected ex-dividend dates. Now we're only looking for stocks with ex-dividends next week, so I'm selecting the 16th through the 20th. If you're looking for a specific stock during a quarter, so some investors, if they pick up 3 stocks, they may select a January paying stock, a February paying stock, and a March paying stock. And then those specific stocks pay out every other 3 months. So those 3 stocks on each different month would pay you every single month of the year. And I covered that in a video called How to Get Paid Every Month with Blue Chip Companies, something along those lines. I'll have a little link here above. But what I've done next is sorted it by the DARS rating system. Now, if you guys want to find where this is at, just click on Best Dividend Stocks. Go here towards the bottom. It's going to give you how the dividend advantage system works. It basically just measures how strong that stock has been performing. Is it close to its 52-week high? It doesn't have a dividend yield over 10%, doesn't have a dividend yield under 1%. How reliable is that dividend in comparison to their earnings? Do they have earnings that are between 20 to 50% and pretty healthy, even if they lost half their earnings during a downturn? Or is it much riskier where they have a 70, 80, 90% payout ratio? Dividend uptrend, how likely are they to continue increasing their dividend year over year? Such as, there's lots of stocks out there that have paid dividends for more than 25 years. ADP, JP, Johnson & Johnson, Procter & Gamble, and a number of other ones out there. Earnings growth over the next 4 quarters, are they expected to grow and continue being positive in their future earnings? So that's kind of how it measures it. And then it gives it a rating of 3.6 to 4.5 for recommended and 4.6 to 5 for highly recommended. So for my screening process, I take anything with a rating of 3.6 and higher in order to screen. So here, I just head over here. I've already sorted, search by the next week's dates, and I've already sorted it by the DARS rating system. So I go ahead and I'm going to go ahead and include this header piece here and go all the way down to 3.6. Copy that. Go into my spreadsheet here. And I'm going to go ahead and sort these. Filter. Where's my filter? I know there's a way here to do my filter. Maybe that's it. Maybe not. Okay, anyways, I'm going to go ahead and get rid of this. You can see here, this column is for stock symbols. This column is for company name, the DARS rating, the ex-dividend date, the pay date, the dividend payout, how much you would get paid out that specific payout, depending on how many shares you own, and if the stock is a qualified dividend, depending on your tax bracket and what account you are trading in. If you're trading in a taxable account, you may have to pay taxes on your dividends depending on what tax bracket you fall into. If you are trading within a Roth IRA or other retirement account, then you would be tax exempt. And even if you're buying into these stocks here that are not qualified, you wouldn't have to report it. You have the stock price here and the dividend yield. So of course, we like to screen, or I like to screen these stocks for a dividend yield of under 1.5. I'm going to go ahead and cut them out. So right off the bat, I'm going to go ahead and delete these out. Boom. Now we only have stocks with dividend yields of 1.59 and higher. I'm going to go ahead and resort these by the highest number. Let's see if I can do that here. And there we are. So these are our remaining stocks. So out of 27 stocks that we're currently screening for, we already knocked down the list to 14 stocks. So already ahead there. Let's go ahead and begin entering these here over into Y charts. So these are all in order of how they are rated on the DARS rating system. So we're going to see what stocks are actually remaining through my screening process here. Oracle, MGRC, PNC. So out of the 27 stocks that we had originally looked at, I recognized maybe 5 or 6 of them. So if you multiplied 25 by 4, and then that's 100%. So you take your 5 stocks that you recognized, multiply that by 4, and you would actually have recognized only 20% of the total amount of stocks that we had here. So that leaves us with 80% stocks that are sort of unknown to us as far as what products and services, what moat they are in. So it gives us a nice exposure to stocks that we wouldn't otherwise really hear in the news or really look at and investigate ourselves. So that's the whole point of doing this segment here, the stocks with X dividends next week, because it gives us exposure to stocks we wouldn't hear in the news because they're not FANG stocks. So we've already screened them for dividend yields. I'm going to go ahead and zoom in here. In case you're on mobile, I've had some people mention that they can't see it sometimes if I don't zoom in there on mobile. So here I have a good number here selected. I'm going to go ahead and screen these for price earnings ratio. And we're looking for price earnings ratio less than 25. Now, it's not to say that these stocks are bad at all. They could be growth stocks, they could be somewhat growth stocks. So Amazon, Netflix, a number of other stocks out there have high PE ratios. It's not a all killer altogether. It's just this process that I use. I'm looking for value buy opportunities. So I'm looking for stocks that make it through this process. And it's not always 100% correct, but it has done well for me here in the past. So here we're going to go ahead and just look at purple here, and it's a second here from the bottom, so I'm going to just remove second one from the bottom. We have 30, which is the third one up. We just removed the third one up, and there we are. We're left with 2, 4, 6, 8, 9 stocks with PE ratios under 25 and dividend yields over 1.5. Next, I go down each stock individually, look at how long or how they have done over the last 10 years for their revenue, net income, and free cash flow. And I just changed the data format to % so I can see how much they've either gone up or down over the last 10 years, year over year. So here we have RPM International, we can see that their revenue has increased 4.2% year over year over the last 10 years. We can see their net income has increased by 5.2% over the last 10 years, and their free cash flow has gone up 5.9% year over year on average. Now you just basically just take these numbers, divide it by 10, and that's what you get year over year. So that one passed our screen. This one's it's all positive numbers here. So all I'm doing is going down this list and looking for stocks that have negative numbers, and here we're actually getting nothing. So here we have one with declining revenue. So Apache is negative 54.6% over the last 10 years. So it loses an average of 5.4% revenue per year. So this one, for example, I would just remove it from my list. Continue on here for Procter & Gamble. So Procter & Gamble was recently downgraded recently, and it caused them to lose, what, 1 or 2% here in the stock market. And you can see, if we were just to bring in their price here, over the last year, they have gone down 8.35%. It's not a bad stock, but for my metrics here that I'm measuring it by, this one did not make the cut. So I don't look at names, I just look at the financial metrics, and if it meets the financial metrics, then I will keep it. Main Street Capital, its free cash flow is a bit down, and it is a real estate investment. This is a REIT, so it's pretty common to see free cash flow be down on REITs. A couple other REITs that other people would recognize is EPR, and a few others. And if we kind of go through these, get rid of that one. Okay, so Realty Income, ticker symbol O. This one actually has positive, and another one here positive. So these are both two that I've owned here in the past. So Main Street Capital, I'm just going to go ahead and deselect that one. So here we are left with 6 stocks that have price to earnings ratio less than 25, dividend yields over 1.5, all have rising revenue, net income, and free cash flow over the last 10 years. And we can look at this over the last 5 years as well. And I'm not going to go ahead and remove anything. I think 6 is a pretty healthy amount. But you can see some of these here have gone down recently. Net income for RPM International has gone down slightly over the last 5 years. It's not to say that they're not profitable. If we bring in our original data format, we can still see that their revenue is up at 5.2 billion, and their free cash flow and net income is in the millions. Oxford Industrial, again, revenue up in the billions. So billion and continuing, yeah. So still very good profit numbers there. And there. So these are our stocks that have made it through the screening process, and we could take a little bit better look here at these specific ones. So how much are they paying out right now per share? We could take a look at their price, their dividend yield, price to book value, price to sales, and actually prior to that, let's go and take a look at, here's another screening process I like to look at, price earnings ratio right now and price to earnings ratio forward. So is the company expected in the future to have better earnings, which would cause their PE ratio to drop? So here, RPM International has dropped from quite a bit, here in 2018, once they did the tax reform, they dropped pretty good there. They are currently at a 21.49. They're expected to go down to an 18.18 here in the future. So that is an increase of earnings here. We want the orange under the blue. Orange is on top of the blue. So here, Pentair, for example, it's currently trading at a PE ratio of 11.73. But in the future is expected to climb to a 19.25. So they may have released, hey 1979 Wood, I believe your name was Alex, right? Anyway, good evening. So this company is expected to climb or decline in their earnings, which will be drop or increase in their price earnings ratio. Here we have Williams-Sonoma. We have a current PE of 19.74. 74, yes. In the future, expected to drop to 14.54. I'm going to go ahead and remove Pentair because their forward is expected to climb, which means maybe they put out in the future quarter that they're expected to rise. So here, McGrath Rent Corp, they're currently trading at a 9.65. They're expected to lose maybe some amount of earnings and jump up to a 22.55 PE ratio there. So I'm going to go ahead and remove that one as well. So good guess, good memory there. So we have PNC Financial Services currently trading at a 12.7. In the future, going forward, they're expected to climb to a 13.06. So again, we're going to go ahead and scratch that one out. So here we are left with only 3 stocks this week. It's probably the least amount of stocks I have ever really screened and had remaining on my stocks with X dividends next week. So that is a good screening process. So here, what we're going to be doing now is punching in these numbers here, zooming out just a tad here, and I'm going to go look these up here on dividend.com. And we're going to go ahead, and you can see here, RPM was the very first one here that was rated by the Dividend and DARS rating system. We have OXM here. It's still near sort of the top at a 4.6 rating. And Williams-Sonoma right here, also on top. So out of all 27 stocks that we screened, we're left with some stocks that did have DARS rating system of that highly recommended rating. So I would say that their rating system is pretty on it. So here, all I'm going to be doing first is sorting these stocks by how long they've been paying out their dividends, and basically just these 3 stocks. So first, we have RPM International. This stock has been continuing to grow and pay out their dividend for the last 43 years, since back in 1975. Their payout ratio is at a very healthy 43.4, meaning that even if they lost half their earnings during a downturn, their payout ratio would still remain under 100%, and I would consider that very healthy. Their ex-dividend is on July 16th, so that is next Monday. So you'd actually have to buy this one this Friday, and you would get paid out at the end of the month on the 31st of July. You would get paid out 31 cents per share. They're currently priced at priced at $60.37. So you can see here, you might get a really good discount right now. I know here in the after hours, futures are down pretty hard on a number of stocks. Here in the red, we have that price to book value. That's at a 4.9. It has climbed up recently, so their price has climbed as well. You can see here that they were priced in that $48, $50 price mark, and they recently jumped all the way to $60. So somebody else may have seen this as a great buying opportunity and bought into the stock already. So this one could have a bit of a pullback, but at the same time, it does look like a great buying opportunity, especially if it meets some of the other numbers here. So price to book here, I think that's what this is. Green is price to sales. So pretty healthy price to sales at a 1.5. So overall, great looking numbers. Let's bring in that dividend yield in there as well. So this one, if you were to buy in right now, you would capture a 2.09% yield on cost. If you had bought this one just a few months back, say during these dips here, during February, April, and May, you would have got nearly a 2.5% dividend yield. So you lost about a half of a yield there of a buying opportunity. So still a great stock, but it may have a little bit of room to kind of fall back to. So here, if we bring in the price and the dividend yield, you can see over the last year, this price is currently way above anywhere it's been trading at for the past year. And it has been kind of trading here way below expectations. And another metric I like to use is the 200-day moving average. So here you can see for the last year, this was trading way below its 200-day moving average, and it recently shot way above it. So 200-day moving average at $51.33. It's currently priced at $60.37. So someone saw this as a great buying opportunity, very high yield, bought into it, shot up. Great number of dividend growth years there. So next we have OXM. This is a textile apparel clothing company. They have, again, dividend growth for the last 8 years since back in 2010. payout ratio of a healthy 29.7. Again, if they lost half their earnings, they could just still continue to be underneath that 100% payout ratio. Their ex-dividend is on July 19th, which is next Thursday. So you'd have to buy this one on Wednesday or prior. You would then get paid out on August 3rd. I just would like to recheck here. What did they do? So here, they did a stock split 2-for-1 back in 2013. Had continued to raise and pay out that dividend until the recession here in 2008. Then they did cut their dividend by 50%. They pulled a GE and cut their dividend, and then have since that point have raised their dividend. But during downturns, it looks like they have been known to cut their dividend or freeze it, as they did here back in 2000 during that tech bubble. So that is Oxford Industrials. Here, over here on the charts, we can see that the current priced at $85.80. Let's bring in some of our other metrics here. Okay, so there's a number of metrics here. So they're paying out 34 cents per share. It looks like they just increased that payout. So they were paying out 27 cents. They increased it to 34 cents this year. They are currently priced at $85.80. Their 200-day moving average they're trading above their 200-day moving average of $75.55. Their PE ratio is at a 21.01, but they are expected to grow earnings in the future, which will lower this. Their price to book value is at a 3.2. 3.0 is where value investors would consider a value. So this one is trading just slightly over, but at the same time, it's pretty normal for this company. You would have a dividend yield right now of 1.34, which isn't the lowest. You can see here, it's near the lowest, but it's not near the highest. You can see there was a time when this one was trading nearly at 2% dividend yield. And then here, this last number here is the price to sales. So price in comparison to their sales is at a 1.3. So it's a very nice rating there as well. And that was Oxford Industries. And last, we have Williams-Sonoma. I put this one in last only because they do have the same dividend growth, but this one does have a slightly higher dividend payout ratio. So here we move over to Williams-Sonoma and quickly look at, keep that there. Let's see here. Okay, so this one again, you can see that all of these have shot up recently. This one did kind of shoot up, came back down. We're bringing our 200-day moving average. Again, trading over that 200-day, over that 200-day, over that 200-day. Somebody saw these buying opportunities and bought into them already when they were trading below that 200-day moving average. So while these are great looking stocks right now, they have recently shot up out of these value buys. So let's see here. Let's bring in our stuff again. Price to sales, price to book, and that's it right there. Okay, so let's go ahead and cover some of their information. Again, they've been having dividend growth for the last 8 years. Payout ratio at 40%, still healthy. If they lost 50% of their earnings, they would still be underneath 100%. Their ex-dividend is July 19th, so that is next Thursday. You would have to buy it on Wednesday or prior. You would then get paid out on August 24th. Now let's take a look at back in 2010. What did they do to their dividend? So 2010 looks like during the recession they started to pay out a dividend in 2006. The recession happened here in 2008. All they did was freeze the dividend until 2010, and then they began to increase it to where it's currently at. So during recession times, this company is more than likely not to cut it, but maybe just to freeze it. But you can see here, out of these three, RPM is that, that strong one that's paid out during recessions, during multiple recessions. And taking a look here at their financial metrics, this one pays out 43 cents per share. They recently increased their dividend here by quite a bit, from roughly 39 cents per share all the way up to 43 cents per share. So that's a nice hike. They're currently priced at $61.58. Their 200-day moving average is at $52.57. So they are trading nearly $10 over their 200-day moving average. So they may have a bit of a pullback. you can see this huge run up from $47, $48, all the way up now to $61.58. Imagine if you had bought these companies at these value buys below that 200-day moving average, below their average price for the year, and you would get that yield on cost higher than average. They currently have a dividend yield of 2.6, but you could have got a 3.0 and higher back in May. Their price to book value is at a 4.2, which isn't too bad, and their price to sales is actually below 1, meaning that their price in comparison to their sales is actually undervalued. So where they're currently priced at in comparison to their sales. So still, Williams-Sonoma does look like a good buying opportunity. I would just wait for it to come off those highs. So those are all 3 stocks that have ex-dividends next week that all have price earnings ratio under 25, dividend yields over 1.5. They all have rising revenue year over year for the last 10 years, rising net income, and rising free cash flow year over year over the last 10 years. They all recently had a huge push up from their lows where they were trading below their 200-day moving average. So while these 3 did make the cut this week, I would say that neither of them are currently at a value buying opportunity, and I would wait for them to kind of simmer back down near their 200-day moving average. Starbucks, for one, I know this one has came up recently. It's not a stock with ex-dividends next week, but if we just use this one here as an example, and all we're doing is looking at their price and their current yield and their 200-day moving average, Starbucks has a 200-day moving average of $56.76. It shot way below its 200-day moving average. You're getting it at a dividend yield of 2.28%. It was near that 3% rate recently, plus they did that dividend hike, which you're buying Starbucks right now right around that 3% yield on cost. So this one is currently at a value buy, in my opinion. And you can see here over the last 10 years, I'm not sure, let's see if their net income, price, revenue, net income, free cash flow over the last 10 years. So here, triple digits in their free cash flow, triple digits in their net income, and triple digits in their revenue over the last 10 years. So basically 88% year over year, 81% year over year, and 12% year over year. So this just gives you an example of why I use these financial metrics and why I would consider the 3 that did make it through this week's initial screening process. I wouldn't consider them value buys at this time. I would wait for them to kind of come off those highs. So still, that is it for this week for stocks with ex-dividends next week. Out of the 3, I would say that RPM does place in first place just for having that number of years paying out those dividends and growing their dividends year over year. And they have a very healthy payout ratio. So hopefully you guys have enjoyed it. Again, if you are not yet subscribed, hit the subscribe button below. If you did like the video, hit the like button below. I truly appreciate it. If you do like these live videos where you can come in and join, I know it's a little bit late. I'm going to try and get these more around that 6, 7 o'clock Pacific time. That way I can have some more, interaction. I see Alex there in the chat, if he's still there. And that is it, you guys. Thank you guys for tuning in. I will see you next time. As a quick disclaimer, I am not a financial advisor or tax professional. The information provided in these videos is for entertainment and fun. I am just a financial investor myself, trying to help others look for deals. And right now, out of the 3 here that we screened, I don't see any value opportunities. But come tomorrow when the markets are down, these could come down pretty hard. So that is it for this video. Thank you guys for tuning in. I will see you next time. Have a great day. Bye.